Hello, and welcome to This Explainer. Today we're acting as a specialized analytical engine to tackle a highly complex area of international tax compliance. And look, the stakes here are incredibly high. A single assumption can literally trigger catastrophic financial penalties. Our analytical goal for This Explainer is crystal clear. We're going to rigorously deconstruct the actual mechanisms and the cause and effect relationships of treaty-based tax return positions, entirely stripped of all that generic filler. We're focusing strictly on actionable insights, the implicit assumptions people make, and the really non-obvious details that govern Form 8833. So let's jump right into the structural analysis, shall we?
Right out of the gate, I want to immediately challenge a really common implicit assumption. Think about this for a second. If a tax treaty entirely eliminates your tax liability, is a tax return still legally required? Well, a lot of people instinctively assume that the relationship between a zero tax liability and statutory reporting requirements is just perfectly linear. Basically, they think, hey, no tax owed mathematically means no paperwork required, right? But as we're going to uncover through our rigorous analysis of the source material today, this surface-level logic isn't just mathematically flawed, it's actually a profound regulatory risk that traps thousands of taxpayers every single year.
So let's get into the mechanics of this. We'll start with Section 1, the disclosure mechanism, Form 8833 Basics. What exactly is a treaty-based return position? At its core, it's a formalized regulatory claim. It happens when a taxpayer actively asserts that a specific provision within an international treaty legally overrides standard domestic tax law. The absolutely crucial point here is that a treaty benefit is never an automatic right. It's not some self-executing shield that just magically applies in the background while you go about your day. No, it is an active, conditional election. You're legally required to formally stake your claim under Statutory Code Section 6114. And why is that? Because without this formal disclosure, standard domestic tax laws are going to apply by default, which makes sense. Otherwise, invisible tax evasion would be way too easy. Form 8833 is the exact required mechanism you use to deliberately declare your position to the tax authorities. And that brings us to a core principle drawn directly from anonymous expert reports. Every treaty is unique. Assumptions are the enemy of compliance. You simply cannot rely on blanket generalizations here. Treaties aren't just copy-pasted templates, right? For instance, a highly advantageous tax shield that you might find in a treaty with France might be completely absent in a treaty with the UK. The definitions of residency, the withholding tax rates, explicit statutory exclusions, they all vary wildly from border to border. Operating on assumptions rather than analyzing the specific individualized text of a treaty is a dangerously risky pathway. It can basically compromise your entire compliance structure right from day one. All right, let's move forward and look at Section 2, Tiebreaker Residency Rules, Navigating Rules. When you're dealing with residency reclassification, you're essentially standing at a fork in the regulatory road. On one path, you've got the standard route, filing as a typical domestic resident, where you're broadly subject to global taxation. On the other path, you have a highly specialized route, formally electing non-resident status. Now, if an individual legally qualifies as a resident domestically, but also claims residency in a foreign country under the binding, very specific rules of a tax treaty, they can utilize a specialized non-resident return, which is often categorized as Form 1040NR. But here is the vital, uncompromising mechanism you need to remember. That non-resident return absolutely must be filed alongside Form 8833 to legally validate and explain the treaty position you're taking. So what's the exact step-by-step analytical process required when you're executing this tiebreaker claim? First off, you have to evaluate the specific residency articles of the unique treaty you're looking at. Does the individual actually meet that specific treaty's exact definition of a resident? Second, you've got to determine if that categorization legally allows them to be treated as a non-resident for domestic tax purposes. Finally, if those strict conditions are met, you must attach the mandatory Form 8833 disclosures to your return. Expert analysis heavily emphasizes a really critical, non-obvious detail here. This isn't some passive status you just inherit because you moved overseas. It's a highly technical, aggressive election that requires precise, affirmative execution if you wanted to hold up under an audit. And that brings us perfectly to Section 3, the zero tax fallacy, filing requirements. We really need to address the most pervasive and honestly dangerous assumption in international tax compliance. Here's the axiomatic rule you need to remember. Zero tax liability does not negate the statutory requirement for formalized reporting. Let's say you own an entity or you have some foreign income and you believe a treaty provision perfectly exempts 100% of that income. You might think, great, I'm effectively invisible to the system. But tax authorities, they don't do invisible. They demand an informational return to verify exactly why you own nothing. The mathematical absence of a tax bill never equals the absence of a disclosure obligation. Let's actually trace this cause and effect sequence to see how it works in practice. Step 1. You analyze and apply a specific tax treaty provision to your generated income. Step 2. Because of that precise provision, your calculated tax liability mathematically drops all the way down to zero. And step 3. This exact event, the utilization of the treaty to eliminate your tax burden, directly triggers the mandatory effect of executing a Form 8833 disclosure. You literally have to write down the exact details of the treaty article you used to exempt your income so the authorities can track it. The disclosure itself is the structural bridge that makes your zero tax claim legally valid in the real world. Let's transition over to another highly technical application in Section 4, income source reclassification, source optimization. We really must distinguish between standard domestic sourced income and income that is actively reclassified as foreign sourced. Certain treaties feature really powerful specific provisions that allow income that would normally be categorized as strictly domestic to be legally shifted to foreign sourced. And the analytical motive here is, well, it's highly lucrative. You do this to optimize foreign tax credits. Standard domestic income has these rigid, unforgiving boundaries for applying tax credits. But if a treaty allows you to reclassify it, you step into a completely different regulatory framework with massive tax-saving potential. However, and this is a big however, accessing this framework requires absolute strict adherence to disclosure reporting rules. Breaking down the sequential logic here, the expert sources lay out a precise 5-step mechanism. First, you identify the domestic source income. Second, you rigorously apply the specific treaty provision that actually allows for the shift. Third, you formally reclassify it as foreign source on your ledger. Fourth, and pay attention because this is a critical, non-obvious detail that traps a lot of people, the taxpayer must calculate a completely separate foreign tax credit limitation for each type of income sourced from that specific treaty country. And finally, step 5, the taxpayer has to actively execute Form 8833 to legally formalize this reclassification claim. It's a very intricate chain of cause and effect, and you simply cannot take shortcuts. Which brings us to our final analytical phase today, Section 5, Actionable Compliance Thresholds, Actionable Insights. Let's categorize the actionable boundaries of compliance. We need to specifically define when disclosure is strictly mandatory versus when it's actually waived. So disclosure is non-negotiably mandatory in scenarios like claiming tiebreaker residency, reclassifying your income source, or overriding domestic statutory withholding rates just to secure a lower treaty rate. Now, there are some very rare expert-identified exceptions where reporting is explicitly waived. The statutory code does outline a few narrow, highly specific scenarios where the Form 8833 attachment isn't required. But finding and verifying these exceptions, that requires some granular analysis of the regulatory instructions. You can never, ever just assume your unique situation magically falls into the waived category. Synthesizing our deep dive into these expert reports, here are the absolute, non-negotiable insights you need to take away from this. First, treaty positions are never automatic. they are active, deliberate elections. Second, timing is quite literally everything. If you miss the filing window, your election could be entirely invalidated by the authorities. Third, ignoring the Form 8833 disclosure leaves you completely exposed to severe compounding penalties and interest, even if your underlying math is entirely flawless. And finally, every single assumption you make must be actively validated against the explicit text of the treaty in question. No exceptions. To wrap up this explainer, I want to leave you with a provocative question to really stress test your own compliance architecture. Are your international tax positions actually built on statutory reality, or are they just built on implicit assumptions? As our analysis has proven today, relying on surface-level logic, like that incredibly dangerous idea that owing no money means filing no forms, is a catastrophic regulatory risk. The actual mechanics of Form 8833 demand precision, concrete proof, and proactive disclosure. Thank you so much for joining me in deconstructing this complex framework today. Keep questioning the implicit and always verify the text. Catch you next time.